Joining me now is David Rosenberg, the founder and president of Rosenberg Research. David, it's great to see you. Look, everyone's celebrating the small caps. They're finally participating. It's not just the big guys anymore, the little way. This should be a David and Goliath happy story, right?
Well, I sort of chuckle when everybody's talking about the Russell 2000. I'd probably rather talk about the S&P 600, which at least are quality companies. I mean, there is not a junkier index out there than the Russell 2000. And, you know, when you look at what the stock market's done since Liberation Day, the companies that make no money or lose money, their stocks in aggregate have outperformed companies that make money by 2,000 basis points. So, yeah, I guess that, this is going to the casino. This is what the stock market's become, basically. It just, everything that you just talked about in the intro just tells you how speculative and to a large extent how junky this rally is.
I suppose I would want to look at it and say, finally the Mag 7 are cooling off. Sure, they make money, but people are concerned about how much going forward. And finally, the rally is broadening and going to other, even if we just focus on the S&P 500. I take your point about the Russells, and you could put that to the side. I'm curious, Dave, while you're here, your larger thoughts, because underpinning the broadening of the rally has been falling interest rates, right? Like, that's kind of the real story of this rally the past couple of years. Does that get called into question at all now? What do you make of the PCE data? Are we at 3% and headed there? That's what the market's worried about, I think, for the December figures. And does that stall out kind of the disinflation, if I may, that has helped the market do so nicely?
Right. Well, look, let's just say that back to your first point, I'll get to the second point. The first point on generative AI and the technology dominance has spread its tentacles through so many other aspects of the stock market. Investors are buying, energy infrastructure, and they've been buying utilities and pipelines and financials, because financials, of course, are going to make a lot of money from, the M&A boom and the IPO boom. It's all coming from AI. So, talk about the broadening of the market, it's a bit funny because it's all basically connected to AI. It's just these are various derivatives of what's been going on. In answer to the question, I think just what's happening in the stock market is not about interest rates. It's about ebullience and incredible investor confidence over the future. There's no doubt that we've had a massive shift in the innovation curve, but there's still lots of question marks in front of what the total addressable market is ultimately going to be for AI. But investors right now have laid down their money like they did with the internet back in the late 1990s. It's just really about investor confidence.
Right.
That's the bottom line. Is it about interest rates? Not so much, because the Fed's cut interest rates by 175 basis points, but yet the interest rate that should matter the most for a long duration asset, which is the 10-year or 30-year bond yield, they haven't moved that much at all. Do I think the Fed will be cutting interest rates? Yes, I do, but I think for now they're on hold. They're sounding very hawkish. I thought the inflation numbers today were great across the board, especially the core numbers. And I think there is valid reasons to believe that inflation will be a downside surprise through 2026.
Really?
Yeah.
And why is that?
Well, I'll tell you why. Firstly, the tariff impact, as Jay Powell told us in December, that's the irony of ironies, is that the biggest dove on the FOMC is Powell, but he's a bit of a lame duck chairman. I don't know why Trump picks on Powell so much. They almost have the same view on interest rates. It's a committee. It's not one person. Powell's got a powerful vote, but it's still one vote. The committee is more hawkish than he is. Can't say I really know why. But maybe they just don't want to do anything until we get a new chairman coming in May. So it could be just the timing issue. On the inflation, a couple of things. First is that, as Powell said some interesting things at the December at the podium after the meeting. He said that when you strip out the tariff impact, which has been lighter than people have thought,
right,
core inflation is running in the low twos. We're almost at target. All these people talking about we're 2% too much above target, too much above target. You're almost at target once you strip the tariffs out. And then Powell tells us that the tariff impact peaks out this quarter. So what are you complaining about? We're almost at target as is. And on top of that, and Powell, once again, I mean, I was there thinking to Powell, I want to go up there and give you a hug. He was talking about the shelter disinflation because we haven't seen the rents have been deflating for 18 months in real time. But because of the distributive lags and the CPI numbers, it takes a long time to filter through. But that's going to be a dominant theme, and that's 30% of the CPI. Then on top of that, you know, we talk so long about, see, we're talking a lot about food prices, right? But food inflation has come way down. In fact, you know, remember that I said that, you know, rents and OER are 30% of the CPI. Mm-hmm. Food is like almost 14%. And food prices in the wholesale market and in the commodity pits, you know, the Goldman Sachs Agriculture Commodity Index is down 12.5% year over year. And that hasn't shown up yet through into the PPI and CPI. We're still talking about food price inflation. Food prices are extremely high, but I think that inflation is not a level that's a rate of change.